In recent years, financial regulators and central banks around the world have recognized that they have to play a role in recognizing and mitigating climate-related risks. Recognizing such risks would help the financial sector to reduce their exposure to assets and industries that are subject to these risks. So how can we assess financial risks associated with climate change? A new approach by the IMF and the World Bank staff provides a bank solvency stress test with coherent climate change, disaster, and macroeconomic scenarios, using the case of the Philippines as an example. Let's listen to the details.
Is climate change set to transform finance? Could a warming planet devastate banking system? What do changing weather patterns mean for one of the world's most typhoon-prone countries? I am Paola Morales Acevedo. I'm part of a team that recently developed a model to assess the impact of climate change on the health of the Philippines banking system. I work in the division of the Monetary Capital Markets Department, where 21 of my colleagues and I are devoted to one theme. We analyze if a country's financial system can avoid crisis and support economic growth. As part of that analysis, we develop and run so-called stress tests that evaluate whether or not financial institutions can survive extreme but plausible shocks. Recently, those of us evaluating global financial stability have opened our eyes to the risk that climate change poses to banks. In financial systems, insurers already take into account some climate risks. They offer property insurance for natural disasters, including catastrophic events that could happen only once in 100, 250, or 500 years. But adding climate change risks to bank stress tests is a completely new challenge for us and central bankers. We are macroeconomists, not climatologists. So what could we do? Well, for the Philippines project, we didn't have to go far, just across the street, in fact, to the World Bank. We collaborated with our World Bank colleagues by focusing on our respective strengths. They have experts in climate science and catastrophe risk insurance modeling, and we are experts in macroeconomics and financial stability. So they brought expertise in having worked on climate and disaster scenarios, and we focus on the financial and macroeconomic impacts of those catastrophes. The Philippines was a natural choice for this project. The country tops the world in frequency of typhoons with an average of 20 a year. All of the Philippines' major cities and most of the population are situated in coastline areas. This includes the capital Manila, where about 60% of the country's economic activity takes place and where more than 96% of banks' exposures or loans are concentrated. Now, Manila has never been hit by a major typhoon, but it could happen roughly once in 250 to 500 years, and that could have devastating consequences for the economy and for the financial system. The World Bank climate scenario takes an internationally accepted fast global warming scenario and estimates its effects on typhoons in the Philippines. We found that the frequency of typhoons is likely to decline, but their severity or their wind speed could go up in the future. Our disaster scenario estimates the loss of buildings and infrastructures from extreme typhoons, assuming a severe typhoon risk when fast global warming happens. Then the IMF team estimates future disasters' macroeconomic costs and damage to the health of the banking system. Our end result was a macroeconomic model that translates the loss of infrastructures to economic growth and other macrofinancial indicators. After that, we applied a standard IMF bank solvency stress test module to see the potential declines of banks' capital ratios, that is, the ratio of banks' capital to its risk. In order for it to be the comprehensive approach we sought, it had to be built with a climate change scenario as its base, instead of an ad hoc increase of disaster risk. The good news? The Philippines banking system passed our test. Our results suggest that the Philippines financial system is resilient to typhoon risk now and into the future. But in the case of a compound shock, for instance, if a severe typhoon hits the country in the middle of a pandemic, climate change could cause significant risk to financial stability. Our results, however, should be interpreted with a lot of caution. Global temperature projections include a great deal of uncertainty due to the challenge in capturing the global climate comprehensively. Catastrophe risk models can examine disasters individually. For instance, flooding is treated separately from destructions of buildings by typhoon winds. Analyzing increasing sea levels and droughts necessitate different approaches. Climate stress testing is still a new practice, Our Philippines model is our first attempt at building an approach to bank solvency stress testing with coherent climate change, disaster, and macroeconomic scenarios for an emerging market economy. And we can expect many more. The IMF intends to incorporate this type of exercises as part of its financial stability assessments moving forward. Without understanding what climate change will do to our economies, we can't do our job in helping to preserve financial stability, and we can't fully understand our new financial reality.